Hi, I'm Stuart Porter, Chartered Financial Planner, will draftsman and author. I've been based in the UAE for 25 years and I help British expatriates manage their wealth. The following is a summary based on publicly available information about the UK budget which was held yesterday, 26th of November 2025. It is not personal, financial, legal or tax advice. Today I want to highlight the changes from yesterday's UK budget that matter most to British expatriates living here in the UAE. The budget didn't touch headline income tax or VAT. Instead, the Chancellor chose to raise money from three areas: income from savings and investment, property income, and inheritance tax. We also heard major changes to national insurance for people living abroad. For many of you, these changes are important because they affect your UK assets, future state pension, and any possible return to the UK. So let's start with national insurance. This is the biggest change for expats. From April 26, you won't be able to pay voluntary Class 2 national insurance if you live overseas. If you want to keep building your UK state pension, you will need to use the more expensive Class 3. You must also have at least 10 years history of living or working in the UK before you can pay voluntary NI from abroad. In simple terms, the cheap way to build your UK pension while living in Dubai is ending. What you should do now is check your national insurance record, see how many qualifying years you already have, identify any gaps, and decide whether to top up before April 26, when the rules change. This is a personal decision and depends on your wider retirement plan. Turning to tax on income from UK assets, this is rising. This affects non-residents who still have UK income. Looking at property, from April 2027, rental income will be taxed at 2% more after allowances, exemptions and reliefs. This takes the basic rate to 22%, higher rate to 42%, and the additional rate to 47%. If you own a buy-to-let property, these will apply to your rental profits. Dividend income. From April 26, dividend tax will also increase by 2 percentage points for basic and higher rate tax bands. Non-residents will lose the old dividend tax credit. This means that many expats may now face UK tax on dividends from UK companies. Savings. Interest from UK bank accounts will also be taxed more heavily from 2027. If you've kept cash or investments in the UK because it felt easier, now is the time to review whether that still makes sense. A few people here run UK companies while living in Dubai. The government is closing the gap that allowed some people to take dividends during a short period of non-residence. From April 26, all dividends received while temporarily non-resident will be taxed in the UK. If you plan to extract value from a business or return to the UK later, you should take proper tax advice before making decisions. The budget continues the recent trend of tightening inheritance tax rules. Two key allowances are frozen until 2031. They are the nil rate band, which is £325,000, and the residential nil rate band of up to £175,000. Over time, more estates will end up paying inheritance tax. From April 27, pension pots may fall into the inheritance tax net when you die. This removes the tax-efficient way of passing on wealth to the next generation. Executors can also ask schemes to hold back funds for potential tax liabilities. Certain offshore trusts will now face limits on the amount of excluded property they can shelter, and there are also new anti-avoidance rules for UK agricultural property held offshore and gifts to non-UK charities. For most expats, this won't affect day-to-day life, but the signals are clear. The UK wants to tax more wealth. Complex offshore structures will attract more scrutiny, and if you have UK assets or long-standing trusts, it's sensible to review your planning. So what can you do? To make this practical, here's a short checklist. Review your national insurance record and consider filling up any gaps before April 26. Look at your UK rental property. Higher tax may reduce your net return. Check where your investments are held. UK dividends and savings will soon be taxed at higher rates. Review your will and estate planning if you hold assets in more than one country. Consider long-term plans. If you may return to the UK within the next decade, plan early. UK residency rules, inheritance tax rules and pension rules interact in ways that can cost families money. My role is to help you understand these changes in plain English and build them into your wider retirement, investment and estate plans. In summary, the message from this budget is simple. The UK has chosen to raise more tax from wealth and assets rather than from salaries. As British expatriates, we enjoy the tax benefits of a UAE life. But UK rules still matter if you own UK property, have UK investments, or want a UK state pension. I'm happy to walk you through your situation and highlight what applies and what doesn't. I hope this presentation has been useful, and I look forward to hearing from you.